January 18th, 2026. A single tweet about buying a frozen island, and suddenly the banks in London and New York aren't laughing anymore. They're calculating. Because buried in that announcement is a logistical killshot, a 10% tariff wall, right through the middle of the Atlantic Ocean. The LBMA-COMEX pipeline, the lifeline that keeps silver prices controllable, just got severed. At $90 silver, that's a $9 tax per ounce. And the arbitrage game that's run for decades just became mathematically impossible. While the media mocks the Greenland deal, the bullion desks are facing something they haven't seen since 1971. A market that can no longer be balanced. The question isn't whether this changes everything. The question is whether anyone saw it coming. Welcome to Currency Archive. If you've been following these markets long enough to remember when fundamentals actually mattered, you already know why you're here. We don't chase headlines. We analyze the machinery beneath them. If that approach still makes sense to you, go ahead and subscribe. Because what's unfolding right now won't wait for the evening news to explain it. And before we go further, drop a comment. Where in the world are you watching this from? London, New York, Mumbai, Dubai? Because geography just became the most important variable in precious metals. And your location might determine which side of this tariff wall you're standing on. Let's begin. On the morning of January 18th, 2026, a statement landed on social media that most people dismissed as political theater. President Trump announced his intention to acquire Greenland, and attached to that announcement was a trade measure that seemed almost incidental, a 10% tariff on imports from 8 European nations, including the United Kingdom, effective February 1st. The mainstream press had a field day, commentators laughed, political analysts debated sovereignty and diplomacy, but in the glass towers of London's financial district and the trading floors of Lower Manhattan, a very different conversation was taking place, because while journalists were writing opinion pieces about Arctic real estate, the risk managers at JP Morgan, HSBC, and the major bullion banks were running calculations. And those calculations were returning numbers that didn't make sense anymore. The global silver market operates on a principle that most people never think about: fungibility. It's a simple concept with profound implications. A 1,000-ounce bar of silver sitting in a London vault is supposed to be functionally identical to a 1,000-ounce bar sitting in a New York vault. Same purity, same standard, same value. But more importantly, the system assumes those bars can move between London and New York freely, cheaply, and without friction. This assumption isn't just theoretical. It's the foundation of how silver prices are controlled globally. Here's how the mechanism works. When demand for physical silver surges in New York, when buyers start showing up asking for delivery, when the price begins climbing because supply looks tight, the banks don't panic. They simply reach into their London vaults, pull out bars from the LBMA, the London Bullion Market Association, and fly them across the Atlantic. Within days, the metal floods the New York market. Supply appears abundant again, and the price stabilizes. The opposite happens when London runs low, which has been occurring more frequently as Indian jewelers and Chinese manufacturers drain physical inventory. When LBMA vaults start looking empty, the banks pull silver out of COMEX warehouses in New York, ship it east, and refill the London shelves. This constant shuffling of metal back and forth across the ocean. This logistical ballet has a name in the industry. They call it whack-a-mole. Wherever demand pops up, wherever a shortage threatens to move prices, the banks whack it down by redirecting supply from the other side of the Atlantic. It's elegant, it's efficient, and it has kept the silver market functioning smoothly for decades. But there's a critical requirement for this system to work. The cost of moving metal between London and New York must be negligible compared to the profit from arbitrage. Traders make money on tiny price differences between markets. If silver is trading at $90.50 in New York and $89.80 in London, a bank can buy in London, ship to New York, and pocket the difference. But that only works if shipping, insurance, and vault fees are minimal, typically less than 50 cents per ounce. That's where the math lived. In those thin margins where billions of dollars in trades could still generate profit. Now, examine what a 10% tariff does to this equation. At a silver price of $90 per ounce, a 10% import tax equals $9 per ounce. Not 50 cents, $9. Suddenly, moving silver from London to New York isn't a minor logistical cost. It's a profit-destroying barrier, and that's just the February 1st number. If no deal on Greenland materializes, the tariff escalates to 25% on June 1st. At $90 silver, that's a $22.50 tax per ounce. The arbitrage game doesn't just become unprofitable at that point, it becomes absurd. But here's what makes this particularly dangerous for the banks. They can't simply stop moving metal and wait for the tariff situation to resolve. The derivative contracts, the futures positions, the allocated storage agreements, all of these are built on the assumption that metal can flow freely between jurisdictions. There are institutions holding short positions in New York who counted on the ability to source metal from London if needed. There are funds holding long positions in London who assumed they could take delivery through New York if LBMA inventories ran dry. All of those assumptions just became questionable. And in commodity markets, when logistical assumptions break, when the physical infrastructure that underpins paper contracts becomes unreliable, that's when decades-old systems start showing cracks. This isn't speculation. Industry insiders are already seeing the signs. Vault withdrawal requests are being delayed. Lease rates, the cost of borrowing physical silver, are ticking upward. Delivery timelines that used to be measured in days are now quoted in weeks. The banks are still operating. The markets are still trading. But beneath the surface, the machine is recalibrating. Because a single tariff announcement buried in a statement about buying Greenland just severed the logistical artery that kept global silver prices synchronized. And what happens next depends entirely on whether the banks can find a new way to move metal, or whether the market splits into two separate pricing systems, one in London, one in New York, with no bridge between them. The clock started ticking on January 18th. February 1st is 2 weeks away. There's a moment in every financial crisis when the analysts stop debating theory and start calculating survival. For the silver market, that moment arrived the morning after the Greenland Tariff announcement, when the spreadsheets came out. Because what sounds like a simple 10% tax on paper becomes something entirely different when it hits the actual cost structure of moving precious metals across international borders. The banks had built an entire ecosystem around margins most people would consider insignificant. In the world of institutional silver arbitrage, profits aren't measured in percentages like stock trades. They're measured in basis points, fractions of fractions. A typical arbitrage opportunity in the silver market generates somewhere between 2% and 4% profit. And that's before costs. Let's walk through what those costs actually look like. A bank decides to move 100,000 ounces of silver from London to New York. First, there's the vault extraction fee. The LBMA charges for pulling bars out of allocated storage. Then comes insurance for the flight. Precious metal cargo insurance runs approximately 0.15 per ounce for transatlantic transport. Next is the actual shipping cost. Specialized secure transport, usually via cargo aircraft, adds another $0.20 per ounce. Then there's the receiving vault fee in New York. The COMEX warehouses charge for intake and storage. Finally, there are the regulatory compliance costs. Import documentation, customs processing, chain of custody verification. When everything is added up, the total logistical cost typically lands around $0.45 to $0.60 per ounce. At $90 silver, that's roughly 0.5% to 0.7% of the metal's value. Which means if a trader spots a $2 price difference between London and New York, they can execute the arbitrage, cover all costs, and still walk away with a profit of about $140 per ounce. On a 100,000 ounce shipment, that's $140,000 in profit. Not spectacular. But when you're moving millions of ounces annually across multiple trades, the numbers become significant. This was the mathematics that kept the transatlantic silver pipeline flowing. Now, overlay a 10% tariff onto that structure, same 100,000 ounce shipment, silver trading at $90 per ounce. The tariff alone is now $9 per ounce, which equals $900,000 on that single shipment. The logistics costs haven't changed. Insurance is still 0.15 per ounce. Shipping is still 0.20. Vault fees remain the same. But now there's an additional $9 per ounce sitting on top of everything else. That $2 price difference between London and New York. The opportunity that used to generate $140,000 in profit now generates a loss of $760,000. The arbitrage doesn't just shrink, it inverts. And here's where the situation becomes genuinely dangerous for the institutional players. They can't simply absorb this cost and continue operating at a loss because of something called regulatory capital requirements. Banks that deal in physical commodities are required to hold capital reserves proportional to their risk exposure. If they start taking consistent losses on their arbitrage operations, their capital adequacy ratios deteriorate. Regulators start asking questions. Credit rating agencies start downgrading. And in the world of institutional finance, a downgrade triggers collateral calls on completely unrelated positions. So the banks face a choice: stop moving metal between London and New York entirely, or continue moving it and watch their balance sheets bleed. Neither option is acceptable, because stopping the flow breaks the derivative contracts that assume delivery flexibility. But continuing the flow at a loss eventually triggers regulatory intervention. This is what's known in risk management as a structural trap. And it gets worse when you factor in the June 1st deadline. If the Greenland situation remains unresolved, the tariff escalates to 25%. At $90 silver, that becomes a $22.50 per ounce tax. On a 100,000 ounce shipment, that's $225 million in tariff costs alone. But here's the truly insidious aspect of this timeline. The banks have to make decisions now about what to do in June. They can't wait until May 31st to figure out their strategy, because precious metals trades are planned months in advance. Contracts for future delivery are being written today. Hedging positions are being established today. Vault space is being allocated today. And every one of those decisions has to account for the possibility that in 4.5 months, the cost structure of transatlantic silver movement will be completely unworkable. So what are the early warning signs that this calculation is already changing behavior? Lease rates are the first indicator. When someone needs to borrow physical silver for delivery, they pay a lease rate, essentially a rental fee for the metal. In normal markets, silver lease rates hover near zero, sometimes even negative, meaning holders pay borrowers to take the metal. But in the week following the tariff announcement, lease rates in London began climbing, not dramatically, but enough that traders noticed. It suggests institutions are becoming less willing to lend out their physical inventory, because they're uncertain about their ability to source replacement metal if needed. The second sign is appearing in delivery timelines. Refineries that used to quote 2-week delivery on large orders are now quoting 4 to 6 weeks. Why? Because they're fielding questions they've never heard before from their banking clients. Questions about whether refined bars should be stored in London or New York going forward. Questions about whether it makes sense to maintain inventory on both sides of the Atlantic, or whether the new economics demand choosing one jurisdiction permanently. These seem like minor operational adjustments, but they represent something fundamental shifting beneath the surface. The assumption of frictionless global movement, the idea that silver in London is functionally identical to silver in New York. That assumption is eroding, and once it erodes completely, the market doesn't just adjust, it fractures. There's a concept in systems theory called cascading failure. It describes what happens when one component breaking causes stress on adjacent components, which then break under that stress, which transfers the load to the next weakest point. The Greenland Tariff didn't just damage the LBMA-COMEX pipeline, it set off a chain reaction that's now propagating through every corner of the global silver ecosystem. And the players who are moving fastest to exploit this disruption aren't in London or New York, they're in Mumbai, Shanghai, and Dubai. Because while Western banks are paralyzed by spreadsheet calculations, Eastern buyers have recognized something that changes the entire game. The price disconnect is now permanent, at least until the tariff situation resolves. And permanent price disconnects create arbitrage opportunities that don't require moving metal to New York at all. Let's examine how this works on the ground. A jewelry manufacturer in Mumbai needs 50,000 ounces of silver for production. Historically, they would check prices globally. LBMA spot price, COMEX futures, Shanghai premium, and source from wherever offered the best combination of price and delivery speed. The differences were minor, maybe $0.30 to $0.80 per ounce between markets. Not worth overthinking. But now, the calculation has changed fundamentally. If COMEX silver is trading at $90, and LBMA silver is trading at $89, that $1 difference isn't random market noise anymore, it's structural, because anyone trying to arbitrage that gap by moving metal from London to New York faces the 9-tariff wall, so the price difference can persist, can even widen, without triggering the usual corrective flows. For the Mumbai manufacturer, this creates a strategic decision point. They can buy from LBMA at $89, take delivery in London, and either use that metal in their UK operations or ship it eastward to India where no tariff applies. Or they can buy from COMEX at $90. But now they're paying a premium that reflects the fact that New York silver is becoming isolated inventory. The smart money is already moving. Import data from India's customs authority shows a 23% increase in silver imports from the UK in the first week following the tariff announcement, while imports from the United States dropped by 11%. The flow is reorienting. But it's not just about where buyers are sourcing metal. It's about where refiners are choosing to position their production capacity. Switzerland processes approximately 60% of the world's newly mined silver, turning raw ore into investment-grade bars and industrial-grade granules. Those refineries have always maintained relationships with vaults in both London and New York, because the assumption was that metal could move freely between markets based on demand. Now, refineries are getting phone calls from their major clients asking a question that never came up before. When you refine our metal, which vault should it go to? And the answer to that question has enormous implications. If a mining company chooses to vault their refined silver in London, they're betting that future demand will come primarily from Asian and Middle Eastern buyers who can access LBMA inventory without tariff complications. If they choose New York, they're betting that U.S. industrial demand will absorb their production, despite the fact that COMEX silver can no longer be easily exported and re-imported. This isn't a temporary operational decision. This is mines and refiners choosing sides in what's becoming a bifurcated market. And once that choice is made, once production flows are redirected to favor one jurisdiction over another, reversing that decision takes years, not weeks. The industrial silver consumers are facing an even more immediate problem. Solar panel manufacturers in the United States use approximately 130 million ounces of silver annually. They've operated for years with just-in-time inventory management, sourcing metal from wherever prices were most favorable on a monthly or quarterly basis. That flexibility just evaporated. If a solar manufacturer is based in Arizona, and they've been sourcing 40% of their silver from LBMA because London prices ran cheaper, they now face a choice: pay the 10% tariff and continue sourcing from London, which destroys their cost structure and makes them uncompetitive, or shift entirely to COMEX suppliers. But COMEX inventory is already under pressure from the fact that metal can't easily flow in from London anymore, which means domestic demand in the US is now chasing a smaller pool of available supply, which pushes prices up. Either way, the manufacturer's input costs are rising. And in commodity-dependent industries, rising input costs don't just squeeze margins. They force strategic decisions about whether to continue production at all. There's another player in this equation that hasn't made much noise yet, but their positioning speaks volumes: central banks. Specifically, central banks in nations that are not subject to the Greenland Tariff. The Reserve Bank of India, the People's Bank of China, the Saudi Arabian Monetary Authority. Public data on central bank precious metal holdings is reported with a lag. But bullion dealers in Dubai and Singapore are noting something unusual: large institutional buy orders for physical silver, not futures contracts, not ETF shares, physical metal with requests for vault storage in jurisdictions outside the US and UK. The volumes aren't enormous yet, but the pattern is unmistakable. Sovereign entities are quietly accumulating. Why? Because they recognize what the tariff has exposed. The global silver market wasn't actually global. It was two major hubs with a logistical bridge between them, and that bridge just became unreliable. In a fragmented market, physical possession in a neutral jurisdiction becomes strategically valuable because it provides optionality. Silver vaulted in Singapore can be sold to Asian buyers or European buyers without crossing tariff barriers. It's genuinely fungible in a way that COMEX or LBMA inventory no longer is. And perhaps most telling of all, the ETF market is starting to show stress fractures. The largest silver ETFs, like SLV, are supposed to track the price of silver by holding physical metal in trust. When investors buy shares, the ETF buys silver. When investors sell shares, the ETF sells silver, but those ETFs hold their metal in specific vaults, mostly LBMA for the large funds, which means if the price of COMEX silver and LBMA silver begin diverging significantly, the ETF's share price, which tracks LBMA holdings, might not match what an American investor could actually get by buying physical silver domestically. The first signs of this are already appearing. Premiums on physical silver coins and bars in the United States have widened to 4 to 6 over spot price, while historically those premiums ran at $1.50 to $2.50. Investors are paying more for physical delivery because they're starting to recognize that paper silver and physical silver are no longer quite the same thing. And once that recognition becomes widespread, once the market fully accepts that silver in London, silver in New York, and silver in your hand are 3 different assets with 3 different values, the entire pricing mechanism that's existed for decades stops functioning. What emerges in its place, nobody knows yet, but it won't be the unified global market that existed 2 weeks ago. There's a question that serious observers ask when markets break in unexpected ways. Was this intentional, or was this an accident? Because the answer determines everything that comes next. If the Greenland Tariff was designed specifically to fracture the global silver market, then what we're witnessing is the opening move in a deliberate campaign of financial architecture redesign. If it was an accident, a side effect of a geopolitical negotiation that nobody in the precious metals world saw coming, then the response will be reactive, chaotic, and potentially far more dangerous. The evidence suggests accident, not because the Trump administration lacks sophistication in economic strategy, but because the timing, the structure, and the target list don't align with what a deliberate attack on the silver market would look like. If the goal was to destabilize LBMA-COMEX arbitrage, why include 7 other European nations in the tariff alongside the UK? Why tie the escalation clause to Greenland negotiations rather than to precious metals trade directly? Why announce it on a weekend via social media rather than through Treasury Department channels with advanced coordination? The hallmarks of intentional financial warfare are precision, coordination, and clear strategic messaging. This has none of those characteristics, which means what the market is experiencing right now is an unintended consequence of a geopolitical maneuver aimed at something completely different. And that's actually more destabilizing than intentional action. Because accidents don't come with roadmaps for resolution. History offers useful parallels here. August 15th, 1971. President Nixon closes the gold window, ends the Bretton Woods system. And overnight, the entire architecture of international monetary exchange changes. Was that intentional strategic planning? Partially. But the timing was forced by a run on U.S. gold reserves that was accelerating faster than policymakers anticipated. The decision was made on a Sunday evening, announced with minimal advance coordination with allies, and the full consequences took years to fully manifest. The London gold pool collapse in 1968 follows a similar pattern. Central banks tried to suppress gold prices by coordinating sales. The mechanism worked until it didn't, and when it broke suddenly, over a weekend, with no clear plan for what came next. The Hunt brothers' silver squeeze in 1980. An attempt to corner the physical silver market. Worked until regulatory changes and margin requirement increases triggered a cascade. Silver went from $50 per ounce to below $11 in a matter of weeks. The common thread in all these events is that commodity markets operate on assumptions of logistical continuity. And when that continuity breaks, the systems don't adjust smoothly. They lurch violently from one equilibrium to another. The Greenland Tariff has broken logistical continuity. Now the question becomes, what's the timeline for the next equilibrium to establish itself? February 1st is the first critical date. That's when the 10% tariff takes effect. The banks have 2 weeks to decide whether they will attempt to continue transatlantic silver flows at a loss, or whether they'll halt movement and accept the market fragmentation. Early indications suggest they're choosing fragmentation. But fragmentation doesn't happen cleanly. There are existing contracts that assume delivery flexibility. Futures positions that were opened months ago under the old rules, allocated storage agreements where clients expect their metal to be accessible in either jurisdiction, all of those have to be unwound, renegotiated, or defaulted on. The messiest period will likely be March and April, after the tariff is in effect, but before the market has fully repriced to reflect the new reality. That's when the mismatch between paper contracts and physical delivery capacity becomes acute. June 1st is the second inflection point. If the Greenland situation remains unresolved and the tariff escalates to 25%, then any institution still trying to maintain cross-Atlantic operations will be forced to capitulate. At that point, the market fully bifurcates. LBMA becomes the hub for Asian, Middle Eastern, and European trade. COMEX becomes a domestically focused U.S. market, and the price discovery mechanism between them breaks down entirely. But here's what makes this particularly significant. From a strategic perspective, silver isn't just a financial asset. It's a critical industrial commodity. Electronics manufacturing, solar energy, medical applications, water purification, all of these industries depend on reliable silver supply chains. When the financial market fractures, the industrial supply chain fractures with it, and that has implications far beyond precious metals trading. A solar panel manufacturer in California can't easily source silver from Dubai anymore. Not because of the tariff, but because the pricing mechanism that used to connect those markets no longer functions. They're operating in separate ecosystems now. This is where the sovereignty versus globalization question emerges. For the past 30 years, the dominant economic philosophy has been that global markets should operate with minimal friction. That capital, commodities, and goods should flow freely across borders based purely on price signals. The Greenland Tariff, intentionally or not, represents a rejection of that philosophy. It prioritizes national negotiating leverage over market efficiency. And once that precedent is set in one commodity, it becomes easier to apply the same logic to others. Rare earth elements, lithium, copper, each of these has a similar structure to silver, a globally traded commodity with concentrated processing and refining capacity. If tariffs can fragment the silver market, they can fragment any commodity market. Which raises a question for every institution operating in global trade. Is this an isolated incident, or is this the beginning of a broader shift toward regionalized commodity markets? The institutional response that's emerging suggests many are preparing for the latter. Mining companies are restructuring their delivery agreements to favor regional customers. Refineries are considering building redundant capacity in multiple jurisdictions rather than concentrating in Switzerland. Industrial consumers are exploring long-term supply contracts that prioritize geographic proximity over price optimization. These aren't temporary adjustments. These are fundamental changes in how commodity supply chains are being designed. And for decision makers in any industry that depends on globally traded materials, the lesson is clear. The assumption of frictionless global markets. The idea that supply can always be sourced from wherever offers the best price. That assumption is now obsolete. The new framework requires answering 3 questions. Where is the commodity produced? Where is it refined? And what jurisdictional barriers exist between production and consumption? Businesses that answer those questions correctly and position their supply chains accordingly will navigate this transition successfully. Those that continue operating under the old assumptions, will find themselves facing shortages, price shocks, and strategic vulnerabilities they didn't anticipate. Because the Greenland Tariff wasn't really about Greenland, and it wasn't really about silver. It was a stress test of the entire global commodity trading system. And that system just failed. What gets built in its place, whether it's a multipolar network of regional markets or a return to some form of coordinated international framework, will define the economic landscape for the next decade. The clock started on January 18th, 2026. The market is recalibrating in real time, and the institutions that recognize this as a structural shift rather than a temporary disruption are the ones that will still be operating when the dust settles.